Today, the uncertainty principle, the property imperative weekly to the 28th of March 2020. Hello again, I'm Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and problem news with a distinctively Australian flavour. In this week's review of events, which I haven't covered in our daily updates, we try to unpick what is happening in the markets as central banks throw the kitchen sink, supported plumbing, and the entire heating system of the markets. The current health crisis is pushing and pulling the markets into all kinds of uncharted territory. And while there are some cheers for the bulls this week, the bears are still out having a picnic. And frankly, we have no economic compass, and the data released pre-crisis is pretty much meaningless. It's as meaningful as morning frost on the grass. The Dow slid on Friday despite the fact that it had also been its best week since 1938. We hit that after a 3-day rally, which ran through to Thursday, and so that ended its 3-week bear market, or not. Goldman Sachs said that 2 conditions needed to be met before any talk of a market bottom can be taken seriously. First, the dreaded curve needed to flatten, suggesting some control of the health issue, and we would need to get a sounding on how long the US and European economies may take to recover. Neither is knowable for now. So that means future company cash flows are unpredictable. So how do you price anything? And no surprise then that more companies in the US and Europe and elsewhere have recently pulled their guidance. Yet, the torrents of stimulus that have been rolled out in the US by the federal government and the Federal Reserve have convinced some that the market has bottomed. The US Federal Reserve has already slashed rates to zero and launched quantitative easing, and the Fed will also take the unprecedented step of offering a direct backstop for corporate loans. And the latest data from the Fed shows that their balance sheet grew by 12% in the past week to a new high of $5.2 trillion. And it's worth remembering that they lifted by 25% one week to the next during the global financial crisis, so we might even expect more ahead. And the US House of Representatives is expected to pass the $2.2 trillion stimulus package that will flood the world's largest economy with money to stem the damage. Yet, now the body count is higher in the US than China. I found the rally off the bottom in the last couple of days impressive. I think it's gone as far as it should go, billionaire investor Lee Cooperman told CNBC. The market is in the zone of fair valuation until we get more of a handle on what's going on. I think that one would be very defensive. And I just saw a pig fly past the window with regard to the bottom. Nobody knows. What data that is coming suggests more issues than solutions. The University of Michigan's Consumer Sentiment Index final March reading was the biggest drop since the Great Recession back in 2008, down 11.9. And that is in the same ballpark as the drop of 11.8 after the invasion of Kuwait in August 1990. The index can be expected to decline further in the months ahead, and any sort of bounce back is going to be uncertain and pretty weak. There is no silver bullet that could end the issues as suddenly as the military victory that ended the Gulf War, the university said. And the economic fog will continue for some time with meaningless employment and GDP data out soon, all pre-crisis. But we did get one unsettling data point from the St. Louis Fed this week, a measure of initial unemployment claims, which leaped to nearly 3 million, signs of what is ahead. And this doesn't necessarily include all the gig economy type jobs, which are not necessarily captured in the data. The jobless blowout was announced shortly after Fed Chairman Jerome Powell said that the United States may well be in recession, an unusual acknowledgement by a Fed chair that the economy may be contracting even before data confirms it. And at the close in New York, The Dow Jones Industrial Average fell 4.06%, while the S&P 500 index fell 3.37%, and the Nasdaq Composite Index declined 3.79%. The US currency fell against many major currencies after 2 weeks of gains, which suggests the Fed's effort to relieve a crunch in the dollar funding market was working. The Euro-US dollar was up 1.04% to 1.1143, while the US-Japan rate fell 1.5% to 107.94, and the US dollar index futures was down 1.04% to 98.42. The dollar fell against major currencies as central banks' steps to solve a dollar shortage in funding markets started to gain traction through those cross-currency swaps. The yield on benchmark 10-year Treasury notes fell to 0.0797, while the 2-year yield edged up to 0.28%. Yields were headed for a weekly decline, taking cues from the Fed's extraordinary steps to bolster markets and the huge stimulus package. And in commodity trading, crude oil for delivery in May fell 3.36% to $21.84 a barrel. Energy markets have been caught in a tug-of-war between hopes of stimulus spending and worries about excess oil supplies. And the volatility index of the S&P 500 options was up 7.44% to 65.54. That's down nearly 20 points from its record closing earlier in the month. But far above its usual levels, the index rose on Friday after US stocks fell even after the House of Representatives passed the $2.2 trillion relief bill. The still high VIX reflects both the aftershock of the massive price swings investors have endured, as well as deep uncertainty surrounding the trajectory of the health issues and its economic fallout. In this respect, a VIX still hovering around 60 provides a much more sobering and fair assessment of the level of uncertainty present in markets and the global economy, analysts at Fathom Consulting wrote in a note to clients. Gold futures for April delivery was down 1.25% to 1,630. Gold market participants remain concerned about a supply squeeze after a sharp divergence between prices in London and New York. Planes used to transport gold are grounded, and precious metal refineries are closed. The precious metal has recovered the lost ground from earlier in the month, when investors sold out of gold to cover losses elsewhere or to hold cash in a worst-case scenario mentality, following a whatever-it-takes mentality from the global central banks and the $2 trillion of stimulus in the US. The selling of gold has eased off, and buyers are returning to its traditional safe haven. Over the month to date, gold is trading at 2% higher. Now, it's worth reflecting that in my recent interview with economist and author Harry Dent, he still thinks gold will drop below 1,000 later. And Bitcoin over the last 3 days has been stuck in a narrow range while changing hands at around $6,600. Bitcoin's response to the current financial market turmoil was expected to act as a safe haven, but instead it has fallen along with equities and other risky assets. Bulls are currently constrained beneath the $7,000 price level while attempting to seize the price increase drive, yet momentum is not matched by an increase in trading volumes. Bitcoin's hash rate has plunged 45% after hitting an all-time high of 136 exahash per second and has since fallen to 75. The fall emerged from the impending economic turmoil that is tormenting the entire globe, causing several miners to shut down their operations. And lenders of the group of 20 major economies pledged on Thursday to inject over $5 trillion into the global economy to limit job and income losses and to assist emerging markets with weaker health systems. And the British government appeared to have completed its fiscal initiatives with yesterday's announcement of a support programme for the self-employed. As many as 3.8 million people will be eligible for up to £2,500 a month for 3 months. The programme may cost around £9 billion and bring the cumulative price tag of the government's initiatives to around £100 billion, according to some estimates. Significantly, as part of the economic freeze, the property market in the UK has been stopped. As reported in the Financial Times, the UK government has in effect suspended the country's property market, stopping estate agents from marketing new homes and banning visits to those already for sale. The move on Thursday evening followed calls from banks to freeze the market. Banks expressed concerns about the impact of the health crisis on valuations, and they are also concerned about granting credit when the economy is in freefall. And they have told ministers it has become impossible to survey properties. Bank call centres have also been inundated with anxious homeowners requesting mortgage holidays. And the government had already urged buyers and sellers to delay moving unless it was unavoidable for contractual reasons, but on Thursday it went further, saying no visitors were allowed into properties while the stay-at-home measures were in force, including estate agents, surveyors, or potential buyers. The edict in effect blocks any new transactions taking place after the current round of pending completions. And European finance ministers failed to come up with a comprehensive pan-European plan to finance responses to the crisis, with Germans once again scuttling plans to issue mutually guaranteed bonds. This leaves the ECB as the only pan-European institution to act for the Union now, and investors are understandably concerned that a monetary response will not be enough to create stimulus in the region. And the FT also highlighted that in Germany, cash withdrawals have more than doubled in the country over the past week as its citizens show their instinct to hoard banknotes in a crisis. Yet at the same time, German supermarkets and chemists have started asking people to pay by card if possible, a major shift in a country where 3/4 of transactions in shops are done in cash. The use of contactless payments has jumped. On one hand, it's a worry that people could lose access to their money because of the social lockdowns and financial turmoil stemming from the health issues. The other is a fear that cash itself could be transmitting an infection. So far, the first seems unjustified. The cash will not run out in Germany, said Bundesbank board members Johannes Berman recently. Even if the medical and economic crisis turns into a banking meltdown, most deposits should be safe thanks to national insurance schemes. While German banks are temporarily closing branches, their ATMs will stay open. It is less clear, however, whether the second is a genuine concern. There has been little research on this, and some fear that this might be an opportune excuse for going cashless. And some British supermarkets, like their German counterparts, are urging customers to pay by card rather than by cash. And Bloomberg reported that for 93 uncomfortable minutes, the Bank of America rushed to escape infamy this week. The drama began when Californian Governor Gavin Newsom called out the bank for not offering 90-day grace periods to mortgage borrowers affected by the health issues, despite such pledges by rivals including JP Morgan Chase and Wells Fargo. A journalist tweeted the lashing, and then a talk show host reposted it to his 10.7 million followers. The bank raced to correct what it called the governor's mistake. Just over an hour later, the firm promised it would defer payments on home loans for as long as the crisis required. The power of social media. And across the nation, bankers are on edge publicly. They're emphasising that unlike the last downturn in 2008, they aren't the cause of this collapse, and they intend to help America get through it. Privately, they worry they're destined to get cast as villains. Once the government enacts its $2 trillion rescue package, banks are going to be the last resort for millions of consumers and businesses needing additional support to weather months of hardship. The nation's 8 banking titans have enough excess capital to ramp up lending by $1.6 trillion, but even that probably isn't enough to meet everybody's needs. That means bankers will often decide which borrowers to give relief from existing loans or access to more credit, make or break moments for people and businesses trying to avoid default and insolvency. One of the industry's most senior leaders put it this way: the country's banks are strong and ready to support the economy, but they can't afford to lend irresponsibly to clients who cannot repay. That limits the ability of banks to lend to others. There are also ethical questions. Banks must walk a fine line to prevent desperate clients from overburdening themselves with debts they cannot repay, Citigroup Chief Executive Michael Corbat told the Financial Times this week. That's the last thing we all want to see. And banks have been honouring credit lines they offered to corporate clients in the halcyon years before the crisis. One looming question is whether lenders might invoke the so-called MAC, or materially adverse change clauses, to stop drawdowns. One concern is that some businesses with little or no chance of making it through will siphon off billions in loans that could go towards supporting others. Citing those clauses risks sending shockwaves across the industry, potentially prompting stronger companies to draw down their lines preemptively. Still, one high-level banker said he's expecting to see a few denials this year. Banks are trying to maintain goodwill in Washington, working in close coordination with regulators on measures to shore up the financial system. Earlier this month, a delegation of CEOs from firms including Goldman Sachs, Wells Fargo, Citigroup, and the Bank of America visited the White House to offer reassurances that they could weather the turmoil and help others. To conserve funds for lending, the country's largest banks vowed to stop buying back their own shares through at least to the middle of the year. The move comes at the cost for investors, some of whom would much prefer firms to snap up shares at distressed prices. Hi, it's Liz's interruption, but if you're getting value from this post and have not done so, please consider subscribing to this channel or ring the bell for custom alerts. Plus, please consider supporting our efforts. You can make a one-off donation via PayPal, here's the link, or subscribe via Patreon for as little as $3 US a month or more to get access to exclusive additional content. Alternatively, you can also donate using Bitcoin. Here is the QR code. The links are in the comments below. I really appreciate your support, which enables us to continue to make more great content. Thanks very much. Now, back to the current show. And so to Australia, where UBS highlighted that the fiscal stimulus currently announced is worth around $75 billion, or 3.7% of GDP. But only 1.5% of GDP is for the second quarter. The authorities such as the RBA, the AOFM and Treasury have also created additional support and guarantees of around $125 billion, or 6.3% of GDP. Together, fiscal measures total around $200 billion, or around 10% of GDP. Meanwhile, the RBA's QE has bought $21 billion of government bonds, including $18 billion of Commonwealth and $3 billion of others, or 1% of GDP, or 2% of debt. Lenders also pause repayments, both principal and interest, for 6 months for both SMEs, which costs around $8 billion, as well as household debt, potentially $30 to $50 billion. And they forecast the second quarter GDP at minus 10% quarter over quarter. That would be the worst ever. With the threat of a depression, they revised down the GDP forecast for 2020 to minus 6.1%. And that will be the worst since World War II. Prior downturns, which are mainly demand and or financial shocks, aren't comparable, they say. This time is unprecedented, as the supply side of most of the economy has been partially or fully shut down to combat the health crisis. They forecast unemployment of around 10.5% in just a few months, with upside to go higher, assuming a 2% drop in participation, and they think that a wage subsidy is needed now to provide some hope. Without far larger fiscal stimulus in the very near term, like several countries paying a large share of salaries for at least 3 months, if small businesses keep them employed, there is a clear risk unemployment surges even more to the highest levels since the last depression. And that dire scenario would also lead to an L-shaped GDP recovery versus an expected V-shape, keeping unemployment elevated at more than 10%. And notably, total Australian government debt is now around $1 trillion, or 48% of GDP, and these stimulus measures would increase it by around another $250 billion to around 70% of GDP but the impact on bond yields would be likely significantly offset, with the RBA Governor Lowe already promising to do, quote, whatever is necessary, with no limit on what we can buy. Now, the Real Estate Institute of Australia has said that there are some 3.3 million properties that are rented across Australia, and some 1,419 million will be collected each week to pay the owner, their bank, and tradespeople to undertake repairs and maintenance. There are some 70,000 property managers, principals, real estate agents, and representatives across Australia. They say the calls to place a moratorium on evictions without offering any way for tenants to meet their rental payments means those maintaining and managing rental properties are at risk of not having any safety net for their incomes. The impact is greater in regional areas, particularly those that were impacted by the fires and floods at the beginning of the year. And the REIA has proposed a package of rental support to be administered through the current arrangement for payment through the supplement direct to property management agencies. Now, I call that protecting their turf. Actually, I think payments should go direct to those who are renting. That would be a much better strategy. And finance sector funding remains under pressure. For example, non-bank Athena Home Loans has stopped in-flight applications, saying we're really sorry, but a lot has changed over the last few weeks. Given this uncertainty, we can't proceed with your application right now. And I think a number of non-bank lenders will be under pressure as the securitisation market is playing up. And Michael Rodden wrote that the Australian government has waded into the residential mortgage-backed security market for the first time since the global financial crisis, giving $200 million worth of support to non-bank lender First Mac. Since the Reserve Bank last week pledged there would be no limits on its interventions in the bond market, it has hoovered up more than $20 billion worth of government treasuries, smashing rising yields on the government's borrowing instruments and bringing down the cost of debt for Canberra as it prepares to splurge $250 billion in budget deficit to fight the health issues over the coming 2 years. The Australian Office of Financial Management on Friday sunk $189 million across 6 tranches of First Mac's $1 billion mortgage bond, resulting in one of those tranches where it was the sole third-party investor pricing significantly tighter than the company's initial guidance. That tranche priced at 75 basis points above the interbank lending rate compared with 120 basis points and 275 basis points for other AAA-rated tranches. This meant the government's bond issuer, which was tapped during the global financial crisis with rescuing the Australian securitisation market, a key plank of the local financial system, was able to reduce the costs of funding mortgages for First Mac in a move that should keep ultimately rates low for regular borrowers. Scott Morrison and Josh Frydenberg earmarked $15 billion to be spent through the AOFM supporting the securitisation market, which helps lenders that don't accept deposits to fund home loans by shifting the risk of the mortgage book onto the investors. And over the next year, the AOFM plans on issuing almost $4 billion worth of bonds as Scott Morrison ramps up support for households and businesses in a move that Westpac chief economist Bill Evans this week said would result in budget deficits worth $250 billion over the next 2 years. And that's the first time the government will wade back into the bond market to issue debt since March 2018. And the RBA has bought $21 billion worth of bonds since last Thursday, when it pledged to bring down the yield on 3-month bonds to 25 basis points. Since then, 3-year yields have fallen to just slightly above, to about 28 basis points, in a sign the central bank has begun to calm key credit markets. On longer-dated 10-year securities, yields are 50% lower than a 6-year high reached a week earlier. And the difference between business lending rates and overdraft index swaps, a key measure of how readily banks can raise funds, has fallen near its 5-year average. And finally, to property, with the national auction clearance rate at 56.9% from CoreLogic last week, which is still higher than the same weekend last year at 50.9%. but expect volumes to fall from here. And it's also worth noting that preliminary results from Domain today shows that clearance rates have fallen through the floor to around 35%, compared with 50% this time last year. And whilst there was a large number of properties due for listed to be sold, the number of reported auctions is way down and the number sold is way down too. So I think we can tell which way the property market is going from this point. But CoreLogic's price indices are still pretty strong, but we suspect pretty meaningless now. Frankly, the trends in the Perth market are likely to be a leading indicator of what is ahead, down 20% or more. It's only a question of time. Of course, the question now is, will we follow the UK and stop all property transactions to contain the risks? Time will tell. So finally, tonight, we'll just look at the markets. In Australia, the ASX 200 on Friday was down 5.3% to 4,842. The financials index was down 5.82% to 3,935. And the real estate trusts were down 8.68% to 959. The local volatility index was up 3.25% to 3974. And the ASX 200 futures is pointing down 8.82% to 4,835. ANZ Bank is down 6.59% to 1560. CBA was down 4.56% to 5766. NAB was down 4.16% to 1512. And Westpac was down 5.62% to 1489. The Bank of Queensland was down 3.24% to 478. And Bendigo and Adelaide Bank was down 2.44% to $6, while Suncorp was down 3.51% to 824. Macquarie was down 5.67% to 80.32. AMP was up 2.83% to 1.27. And Lenders Mortgage Insurer Genworth was down 8.45% to 168. McGrath was up 20% to 21 cents. And Innerbic Road was up 13.7% to 5.8 cents. AFG was at 1.32. Mortgage Choice was down 11.45% to 58 cents. And CIMEC, the building constructors, were down 9.96% to 21.70. The Aussie US dollar was up 1.68% to 61.66 because of the weakness over on the US side. And the Euro Aussie dollar was down 0.54% to 1.8070. The 2-year bond was down 9.29% to 0.244, and the 10-year bond was down 7.85% to 0.857. The Aussie Gold Cross was down 1.42% to 2,639, and the Bitcoin Aussie Cross was down 6.99% to 10,352. And in the US, the Dow Jones was down 4.06% to 21,636. The S&P 500 was down 3.37% to 2,541. And the financials index was down 3.31% to 361.62, with Goldman Sachs down 4.49% to 158.34. The volatility index was up 7.44% to 65.54. And the Nasdaq was down 3.79% to 7,502. The US 30-year was down 6.8% to 1.244. The 10-year was down 9.11% to 0.676. And the 3-month was at 0.015. The US dollar index was down 1.05% to 98.31. And in the UK, the FTSE was down 5.24% to 5,510. The gold futures was down 1.25% to 1,625. The WT crude oil was down 3.36% to 21.51. and the Bitcoin was down 6.03% to 6,256. And the S&P 500 futures was down 3.41 to 2,524. And the Nasdaq futures was also down, pointing 3.68% down to 7,568. And just to round it all out, the Italian 2-year bond dropped a dramatic 19.1% to 0.267, indicating further volatility in the Eurozone and specifically issues around Italy's role therein. And that completes the summary of the markets up till the end of Friday, the 27th of March, 2020. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.